Welcome to the Brain Pick a Pro Show, live from Lake Wiley, South Carolina. I'm Larry Goins. Thank you guys so much for watching. I really appreciate it. As you know, this is the show that we bring you the best of the rest, right? We bring you movers, shakers, people who are doing it, who are in the trenches, having fun and making money and willing to share some of their successes with you. So please like this, please share this. Please tell your friends about it, download it. And if you really enjoy it, please leave us some feedback. We really appreciate it. Whether you're watching the video or listening to the audio, please share some feedback. Let us know how we're doing. We really appreciate that. We love it. We also have another show called Brag, Be Rich and Generous. You can find it on Facebook Live. So you can visit LarryGoins.com, bragradio.com, and you can find out more about that. But this is the show, brainpickapro.com, where we interview the best of the rest. And today is no exception. It's a fellow mastermind member, and I interview a lot of people that I'm in masterminds with, because when you get to that level, you're only dealing with people who know what they're doing, they got a track record, and they have some valuable information to share. And like I said, today is no different. Good friend of mine, he knows what he's doing. He understands the business. He's even made the switch, right? The switch from residential over to self-storage. So please give a good, warm welcome to Fernando Angelucci. What's going on, buddy?
Hey, Larry. How you doing?
Man, I am doing good. How about you?
I'm doing real well. It's finally starting to warm up here in Chicago a little bit, so can't help but smile a little bit, you know?
Oh, I know. Chicago. Well, see, we can't see you. You're hidden behind the microphone.
Yeah.
That's good. So guys, Fernando, he started out doing real estate. You're an engineer by trade, right?
Correct. Yeah, I graduated from University of Illinois with an ag bioengineering degree.
Wow, that's amazing. So, and you were working for a Fortune 50 company, and then you kind of got the real estate bug. You read a book that got you into the real estate bug, right?
Right. Yeah. When I was 16 years old, I read Rich Dad, Poor Dad. And at that point, I realized that I was going to become an entrepreneur. And, you know, the book uses real estate as an example of being an entrepreneur. But I didn't really know I was going to go into real estate until I was about 19 or 20 years old.
Okay. That's awesome, man. So tell us about that. How did that transpire?
Yeah. So read Rich Dad, Poor Dad. It was always in the back of my mind. I started going throughout his entire series. He has, you know, a lot of the base level series, and then he has his Rich Dad Advisors series that kind of gets a little bit more granular.
Right.
When I was 19, I ran my first business in college. It was called College Works Painters. So they bring a mentor on, they show you how to run a painting business. And on the weekends, you go, you take a bus back from your college to your hometown, start knocking on doors and booking paint jobs. So it was my first foray into you know, managing people, employees,
right,
getting sales together. And from there on, you know, I made good money, but you know, I started reading a lot of books and doing a lot of research on, you know, very wealthy individuals. And I noticed that they either made their money in real estate or they preserved their wealth in real estate. And that's what kind of got me to start looking at it very seriously. So I started devouring books, going to RIA meetings and going to trainings all throughout college. And then by the time I graduated, I was in my 9-to-5. Within the first year, I did my first wholesale transaction. And then I kind of just kept going from there.
That's awesome, man. Tell us about that first wholesale transaction. You were how old at the time?
Yeah, I was 22 going on 23. I think I got under contract when I was 22, and then by the time I was 23 is when we sold it. It was actually with a fellow CG member. So I was in the Des Moines, Iowa market at the time. Finally, you know, went through a bunch of deals that I just didn't do right. I was just kind of trial by fire. Finally locked up a deal at the right price, but I didn't have a buyer's list really built up yet. So I called Mark Lane, who was kind of the prominent wholesaler in the Des Moines, Iowa market, and he found the buyer for me. So that was my very first deal.
That's awesome. You did kind of a joint venture or co-wholesale deal with him.
Yeah, exactly.
That's awesome, man. How much did you make on that deal?
I made $2,500 on that deal.
even though it was only $2,500, you were hooked, weren't you?
Yeah, because it was the proof of concept. I was hustling for. I probably didn't get my first wholesale deal until after about 6 months of trying. So it was the one. That was the deal that said, okay, you fine tuned everything. This is the real way to make money, and I knew it wasn't going to be the end all be all. I knew wholesaling was kind of the transition to build up capital to get into the real wealth wealth creation, which is passive income.
Right, right. Now, what does your wholesale business look like today?
Yeah, so it grew kind of too quickly for us. We were in a lot of different markets. We decided to focus down. So now we're only in the Chicago market. That's where I live now. We do anywhere between 35 to 50 transactions a year. The average wholesale fee is going to be between $16,000 and $40,000. So we only focus on the deals that have a larger spread, just for the sake of time, because we are using that wholesale business as a way to build capital into other passive income vehicles.
Sweet, sweet. So your average deal is 16 to 40K. You do about 35 to 50 of them a year. And so how do you generate the leads for those deals?
Yeah, so about 30% of our deals just come from referrals. So we've been in this market for about 4+ years now. And if anybody has ever heard me talk on any other podcast or met me in person, I subscribe to the abundance mentality style of doing business. And that has turned out to be, one of the greatest things that has happened to us. What we found is if we give, eventually it starts coming back tenfold. So 30% of our deals come from the attorneys we work with, title agents, other wholesalers that, they called me and said, "Hey, Fernando, can I buy you a beer? Teach me how to do your business." And, 6 months later, they find a deal that they can't move and they call me to help them sell it. Our cash buyers, sometimes they have deals where they make 5 offers thinking one's going to get accepted and then 3 get accepted, and they don't know what to do with the other 2 contracts. They say, "Hey, let's make money off those deals. Don't just cancel the contract because you don't have the rehab funds."
Right.
So we've moved deals like that. And then the other 60-ish%, it comes from direct mail. That's our only form of marketing right now.
Okay, cool. How many postcards are you sending out a month?
Yeah, we moved away from the postcards because we saw our conversion rates were a lot lower. We do full size letters.
Wow.
And we'll send anywhere when we're doing very hyper targeted campaigns that are, very small but high impact. You're looking at about 2,500 letters a week. The highest we've ever gone on a less drilled down campaign was close to 6,000 letters a week. But we found that doing list stacking, making sure that there's multiple triggers of motivation, maybe they're on probate list and it's a vacant house and they're out of state owner, those deals have a much higher conversion rate as well as a higher profitability per deal.
Now, where do you get your list from?
Yeah, so there's a few different areas. One of the lists that we get is from a website called public-record.com. They have an API that pulls from all of the northern counties in Illinois directly from the county courthouse. So we get, all of the probate, anything that has to go through the court system, we get that from that list. And then the rest of our leads we get through a local list provider here in Chicago called Exact Data.
Publish-record.com?
Public-record, correct.
That's cool. That is good. That is good.
Yeah.
So would you mind explaining, and we're going to get really into the self-storage in a minute, but would you mind explaining what list stacking is to people that may not have heard that term before?
Yeah, so we found that when you add multiple levels of motivation, the leads that we're getting were much more qualified. So we were getting lower response rate, a lower number of calls, but the response rate was higher, and the call to appointment and appointment to contract ratios were much higher as well. So for example, one list stack that we always do is we always start with absentee owners. Those are usually the easiest ones to close just because they're not around. It's a lot harder for them. Sometimes the property becomes a burden for them. From that point on, then we start looking at other additional factors. Is the property vacant? Maybe that's additional, it's not income producing at this point. Did the property show up on a probate list? So maybe the reason they're an absentee owner is because someone, their family passed away and left this property for them. They just found out about it, and now they have to try to either dispose of it or get it up and running while not being local. And that's very difficult for people that have not, perfected a system of out-of-state investing. So those three criteria on top, and we're stacking those three lists and only sending to the people that hit all of those criteria.
Right, right. And that's really good. And there's some websites out there. There's a guy in CG, Collective Genius, our mastermind, that does that, right?
Yeah. Mm-hmm.
I'm sure that's probably who you use.
Yeah, so there's a few guys. So Chris Richter, he has the Audantic list. That's we actually have a call with him this week to start using his lists. And then we also, just using basic Excel functions, we will just pull the Excel list and then stack them ourselves. I know there's some softwares for the people out there that are not as tech savvy.
Right.
There's a property list manager that you can use to stack lists for you as well, and I think it's super affordable.
Yeah, property list manager. That was the one I was thinking of.
Yeah. Mm-hmm.
Yeah, but we actually use the Audantic list. And just so everybody knows, you got to buy a minimum of 25,000, right? And it's a very expensive list. We love the list. I added some of my own special criteria. We personally mail out 25,000, and we recently increased that to 37.5. So that first drop hits next week. So
nice.
So we're really happy with the list, and we're averaging $15,000 to $30,000 wholesale fees on it.
That's awesome. And you're sending out 30,000 a week or per month?
No, we're sending out 25,000 a week.
Okay.
A month, 25,000 a month. We break it into 4 weeks, but we just increased it to 37.5, another half again as much, added another 12.5, and then that'll be divided by 4, and we'll mail that out.
Gotcha.
And the cool thing about Audantic, those of you listening and watching, is they send you an updated list every quarter. It's been updated, and they have their own list stacking criteria that they do for you. Right.
Yeah.
So what does your team look like?
Yeah, we have a very lean team. So it's acquisitions. So underneath the visionary integrator, which is me and my partner, we have acquisitions, we have a lead manager, and then we have a transaction coordinator. That's it.
That's good. Do you run all the leads in-house, or do you do it over the phone?
We do everything in-house. So we used to use one of these third-party call answering services. Right. We found that the conversions were not as high. It allowed us to do higher volume, but it's hard when someone's not in the local market to build that rapport. So now we have guys that answer the phone, and someone says, "Hey, I'm in this school district," and then they can immediately say, "Oh, I know that school district. I go to the so-and-so shop. I get the dinner at X place right around the corner." It automatically builds rapport. It's very hard for people to do that when you're outside of the market.
That's so true. That is so true. Do you guys run the appointments in-house? Do you go see the seller or go see the property, meet the seller, or do you buy them over the phone?
Yeah, so we've done both to test them out. And what we found is the best thing to do is first qualify the lead and rate it on a scale of 1 to 4. 1 being hot, super urgent motivation where whatever the acquisition manager is doing, they have to drop everything they're doing and go to that house immediately. That's somebody that shows, multiple signs of motivation. They don't have any money. They need to sell immediately. Maybe they have 2 payments, this house and another house, and they're calling every letter that's on their desk, right? All the way down to someone that's extremely cold lead, where they want something like 200% the market value of their property. And they say that they don't care when they sell. It's not urgent for them. They're more of a tire kicker. So the tire kickers, it doesn't make sense to really meet with them unless we have the time. So those people are the ones that they get put, we'll send out a range of an offer over the phone to see if it's something that works. And if it doesn't work, then we kind of just put them on a follow-up campaign until maybe we can meet to them. But the ones that are, the rated 1 and 2 value leads, those guys, we need to get in front of them, build rapport, put a face to the name so they know who we are. We leave behind our seller credibility packages, and we try to get them to sign a contract at the kitchen table.
There you go. That's awesome. That's really good.
Yeah.
So, So let me ask you this question, Fernando. I mean, a few years ago, you made the switch. Now, you still have a wholesaling business. It's thriving. It's making money, generating cash. I mean, 16 to 40, $50,000. Come on. But,
Yeah.
but a few years ago, you made a switch and started purchasing what you call value add self-storage. Tell us a little bit about that.
Yeah. So to back up a little bit, Illinois is an extremely tenant-friendly state. And then even friendlier is Cook County or the city of Chicago, where we primarily do, maybe 50 to 60% of our business. That is what that translates to is extremely long eviction times, rules that almost seem counterintuitive, where the investor is being penalized for trying to get someone out of their property that's stealing from them, basically, right? So that was a huge issue for us. So I went through the entire set of investing kind of options. I went from wholesaling, immediately started buying apartment buildings for rentals, started flipping properties. And what I found with the apartment rentals is we had a few really bad evictions where we had inherited tenants from the previous seller, because this is a tenant's rights state, so you can't kick them out as soon as you buy the property. You have to let them work out their lease. Found out that they weren't paying. We had to go through the entire process. It lasted 13 months just to get one of the tenants out. That's a lot of, not to mention the amount of damage they caused afterwards, which we couldn't go after them for because they basically had no money anyway. So it just would have been wasted legal fees after the eviction. That really changed something in me. So I was actually, I think it was about almost 4 years ago, I was down in Indianapolis at the REI Expo, and I was peeking my head through different rooms because my session had let out early, and all of a sudden I peeked my head into Scott Meyer's room, which is also a fellow CG member. Yeah. And I heard the word triple-digit cash-on-cash returns. So, my ears perked up. I went and sat down front row. He started going through the entire presentation, showing, how you can get phenomenal leverage, that it's a, lien law as opposed to tenant rights law. And I was hooked. I really was hooked. And so at that point, I got as much education as I could, started joining masterminds and mentorship programs, wholesaled the first 2 facilities we found, just to kind of prove the concept to us that we were running the numbers correctly. If a buyer would buy a deal off us with a spread on top of it, we're probably doing pretty good on the negotiations and the underwriting. Right. And then eventually started purchasing existing facilities. And by value add, I mean, the self-storage space has a lot of opportunity because it's an extremely fragmented market. Now, what I mean by that is, of all roughly 52,000 self-storage facilities in the United States, only 18 to 19% of those facilities are owned by the major 6 publicly traded REITs. Then the next largest 100 operators, they only control 9% of the available inventory out there. That means that there's 73% of facilities that are owned by what I call mom and pop operators. They own 2 or less facilities. They usually run it as a secondary source of income, not as a primary business. They're extremely inefficient in their management processes, and they're not using technology to really maximize their ROI. So these are the guys that we're mailing to, just like we would mail to our wholesale leads, our residential leads. We're mailing to them, really trying to approach them and build rapport, and then try to get them to sell us a property for a price that makes sense for them and for us. So here's an example of a deal that we purchased 7 or 8 months ago. We found this facility actually through a broker, and it was at 100% occupancy, which in self-storage is a red flag. You never really want to be above 90, 92%, because it means that you aren't pushing rents high enough. A facility that's at 90 to 92% occupancy will have a higher NOI than a facility at 100% occupancy, because of the way that the facility, the number of units and how you can really push rents. Right. So that was red flag number 1. Red flag number 2 is that it had basically no marketing profile. There's no online presence. It was very difficult to find the facility. The tenants were only able to pay with check or cash. There was no way to pay online. When we started going through the rent rolls, we realized that a majority of the units were anywhere between 20 to 40% below market on the rents. And there was tenants that had been renting for 13, 14 years. We found out that the owner, actually, he was the original owner. He built the facility 30 years ago and just wanted to get out. So we saw a really great opportunity. We purchased it at just under $1 million. So it's 133 units, 16,000 square feet of net rentable square space. And we bought it at about a 7.75 cap rate. So regular purchase, no one's getting super excited about cap rates in those ranges. But then once we started adding our management efficiencies, creating a marketing profile, adding an online portal for them to pay with, increasing rents across the board by an average of 26%, that severely pushed up the NOI. And now the valuation 8-9 months later is close to 1.4, 1.5 million. So we added an additional $500,000 in equity just by doing a few simple tasks to the facility.
That's awesome, man. I love it. I love it. And, and that's the kind of deal that, it's not something where, man, I can rehab this, I can add more units, I can do this. I mean, you found a sleeper. That's what I call a sleeper. It was 100% occupancy, which was a red flag. You go in there and you beef up the marketing, increase the rents, and make it more efficient. And, there's so many things you can do, get an online presence, right? And now you're going to steadily increase the rents every year, right? And who knows, next year you might add another $400,000 in value.
Yeah. And so this facility has a lot of factors on why I chose to start doing self-storage over multifamily and residential rental. So we already talked about the eviction versus lien law. So with lien law, if they don't pay the rent within a 30 to 45 day timeline, I auction off their materials or there's whatever they're storing in that facility, and then I have a tenant the same day. My turn is just me sweeping out the concrete pad. I don't have to paint. I don't have to clean the carpets, right? The next thing is that the leverage that's available to us is fantastic. So on that facility, that Yorkville facility, we got a 30-year fixed, fully amortized commercial loan. That means the bank was holding this loan on their own portfolio because they believed in how safe these loans are. It was a 20% down loan at 5.25% interest. I mean, talk about a slam dunk deal for a commercial property, right? So once I started looking at kind of diving deeper into why banks were chasing these types of loans, I found a lot of amazing data and statistics out there. So just to name a few, it's an extremely recession tolerant asset. When you look between 2007 and 2009, really the heart of the recession, it affected our capital markets as well as real estate values pretty substantially. So there was the National Association of REITs study where between 2007 and 2009, the S&P 500 lost 22% in value. Residential multifamily, they lost about 6.5% to 7%, which on a REIT level, that's a lot, but I know a lot of investors that lost a lot more than that, right? Self-storage only dropped 3.8%. Now, one of the reasons we think for this is when you look at a down market and people are downsizing, they have a bunch of valuables that have sentimental value to them. What are they going to do with those things? You're not going to throw away the paintings that your kids made for you when they were 2, 3, 4 years old. You're going to store those if you don't have the space for it. So that's one of the things that we really like. When we started looking at defaults across bank books, we looked at a Wells Fargo Securities study as well as Intech Solutions, and we found that self-storage had the lowest default rate across all asset classes. You look at average annual default. When you look at self-storage, it was at about 1.5% when it came to the losses that were experienced on those defaults. The average across a bank's portfolio was about 4.8%, and this is across 1998 to 2017. Residential and multifamily had right around the average, around 4.3 to 4.5%. Then when you look at the actual the losses that were experienced, it was the same thing. The second thing that I look at as well is the average annual return. Usually people assume, rightfully so, that if something has lower downside risk, that usually means it also has a lower return, right? Risk versus reward.
Right.
What we find with self-storage is that is not true. So between 1994 and 2017, the average annual return of the S&P 500 was 7.54%. In that same amount of time, this is the average annual return, right? So including the recession numbers. Multifamily returned about 13.3%. Residential returned about 13.4%. Self-storage returned 17.43%. Now that 4% spread doesn't seem like a lot, but when you look at how compounding interest and compounding investments work, so that 4% difference, if you would have invested $100,000 in 1994 into the S&P 500, in 2017 it would be worth a little over $500,000. That same 100,000 invested in residential and apartment buildings would be worth 1.7 to 1.8 million dollars in 2017. That $100,000 invested in self-storage in 2017, it would be worth $4.026 million. So almost a little over double what residential and apartments returned, just because there's an additional 4% compounding interest.
No wonder you love self-storage.
Yeah, exactly. So very low downside risk, very high ceiling for returns.
That's awesome. That's really good, man. I love that. And you can get 30-year fixed rate, no balloon, no call, with 20% down. Seriously?
So we have a bank that's based out of the Midwest. It's actually owned by a grocery store, and they love self-storage on their portfolio because it spreads kind of the risk across their entire portfolio. So they're willing to hold those loans for the entire term. And they said anywhere we have grocery stores, which is about 8 states now, it's going to be 9 states at the end of this year. They said, we will give you this type of loan on any existing facilities.
Good. What kind of rates do they charge? Just a ballpark.
Yeah, so that one was that loan on Yorkville Self-Storage was a 5.25% loan. We closed it about 7 or 8 months ago, and there was just 1 point at closing, 1 point origination.
Oh, that's awesome, man. I love it.
Yeah.
I love it. So where are you going from here? What's next? What are you working on?
Yeah, so finding these value add facilities is getting more difficult. The reason why is as soon as Money Magazine and Forbes started picking up self-storage, it started to become sexy, right? The people that were in the industry since, the big boom of self-storage in the mid to late 80s, they already knew how sexy it was. But the outside world, they saw these boxes, especially these first generation facilities that they don't look really jazzy, They didn't think it was a very great asset. But as soon as these larger media outlets started to cover how the level of cash flow that these things can spit out, now everybody wants to get involved. And because it doesn't take as much management as, say, a apartment building of similar valuation, or a single family home portfolio, a lot of people are getting in and actually having success, even though they have a moderate level of experience. So what we started doing now is actually building these self-storage facilities from the ground up. And the long-term play is we're actually going to follow in Life Storage's footsteps. So we start building up a large portfolio, and then within 10 to 12 years, we're gonna IPO and move it to Wall Street money.
Wow, that's awesome. So now you're raising some money. That's what you're doing right now, raising money for your deals.
Yeah, so right now we have the capacity to do about 5 of these ground-up developments per year. They are pretty large. So that Yorkville self-storage facility I was telling you about, it was $1 million facility, only 16,000 square feet. So it is a pretty small facility when you look at what we're doing now. The ones that we're building now are usually 800 plus units, anywhere between 80,000 to 100,000 net rentable square feet. These are the assets that the REITs really love, that people really like investing in, because you can move a lot of capital in one deal. The cash flows are fantastic. Once we're building one in Aurora, Illinois right now, that once it's stabilized, the net operating income on it will be just shy of $1 million a year.
Wow.
Now that facility, I think we're probably going to sell it to a REIT. So there's 2 strategies you can use. The REITs right now they're cash flowing so much that they literally cannot spend their cash fast enough. In their quarterly meetings with their investors, they're actually getting questions like, hey, why are you guys sitting on so much cash? It's being eroded to inflation. And the response is also the same, is we can't build or buy these facilities fast enough with the amount of cash flow that our existing portfolio is spitting out. So what they're starting to do now is they're looking at these intermediary guys like us, that we build these large REIT facilities, and then we sell it to them either at fully stabilized, which is 90% occupancy in the industry, or a lot of them are now, just to get ahead of the curve and beat out other offers, are starting to make offers at certificate of occupancy based on 30-year projected net operating income.
Wow. That's good. That's good. So what you're doing now is locating the land and developing it and putting the facility on that.
Correct. Yeah. So there's two strategies that we employ on this side of the business. One of them is to find the land and to start building up. Another one, which is kind of unique because of the time in the market we are and how different asset classes are functioning, is what we call adaptive reuse. So an adaptive reuse deal is like one of these, now in the day of Amazon, a lot of these big box stores are starting to shut down, and they're leaving behind these large buildings that are already climate controlled, humidity controlled, dust controlled, depending on what part of the market you're in. So you can get a large, 100,000 square foot building that, say, a Best Buy or a Circuit City or, one of these other large retailers we're in, and half of the deal is already done for you, right? You have a great, these stores are usually located in high traffic areas near dense residential, because that's the target that they're trying to reach, just like us in self-storage. And then instead of us having to build an entire building from scratch, we just have to go inside and then just section it off for self-storage, maybe even build a mezzanine level, so a 2-story facility inside of one of these buildings, because the clear heights of the ceilings are high enough to do so. That saves us a lot of cost, both on the land and on the structure of the building itself.
That's huge, man. I love that. Now you have a climate controlled facility, which you can get more rent for.
Right, exactly.
So I remember seeing one in Florida. It was that kind of, and I don't know if they even still do this or not. I don't know. I haven't seen them like this since. But I saw one in Florida one time. It was a huge open building, and inside was nothing more than chain link fence units, right?
Yeah.
With a gate that you put a padlock on it. Anybody could look in, and as you walk by, you could see what's in everybody's unit, because it's behind a chain link fence with a roof on it, which is chain link fence, and all 4 walls, and the adjoining walls are just one fence. So you walk in to your unit, open up the gate, walk into your unit, and put all your stuff, get all your stuff, but you can see what's in everybody's unit. Do you see any more of those, or is that something that was just a long time ago?
Yeah, so I still see facilities like that. We do ours kind of to the T's. So, ours look like a 3rd generation facility, corrugated steel dividers. You have roll-up doors. There's no way to access or even see what other people have in their units. It's a lot more, it's clean. It looks more professional. I have seen those types of deals, and I've even worked with some investors where that was their plan. It's kind of like the lower cost version of getting into the space. You save a lot more money doing it like that. But again, it always comes down to, because self-storage not only is real estate, but it's also a business, right? It qualifies for SBA financing.
Right.
You got to treat it as such, and you have to kind of look at it from the customer's point of view in their eyes. What do they want to see? Do they want to have all their stuff exposed so people can kind of see what they're storing? I mean, right. Some people are fine with that. Some people are not, right?
Right. That's good. So tell us a little bit about the tax benefits of self-storage, because, there's, you can depreciate, you have write-offs, all that stuff. Tell us a little bit about tax benefits of self-storage and how to maximize that.
Man, there are some, self-storage is one of those areas where it really stacks up with a lot of the tax advantages that are offered in real estate, and especially now with this most recent Tax and Jobs Act. So one of the things that I love to do is I like to find land or find buildings that are already in these existing opportunity zones. These opportunity zones, these are usually areas that the local municipalities want to spur some development, but that's not always the case. You know, everybody's got a friend somewhere and are able to kind of, you know, finagle where these opportunity zones are. The nice thing about the opportunity zones is that you can invest any type of capital gains, not just, you know, the thing that the opportunity zones kind of took the place of were these 1031 exchanges where you do like kind real estate into real estate. The reason why opportunity zones are so huge for real estate investors is that you can start pulling on multiple different sources of capital. For example, somebody has a stock portfolio, it doubles in its lifetime. They decide they want to exit now, and they have $1 million worth of capital gains qualified income or profit. What they can do is they can take that $1 million, put it into an opportunity zone and a self-storage facility that's located in one of these zones, and they can delay the payment of that capital gains tax up to December 31st, 2026, I believe. Now, in addition, you get a step up in basis in 2 separate periods. So the very first period is after you've held that asset for 5 years, that $1 million depreciable basis, it gets stepped up 10%. So now you're only paying taxes on $900,000. Then if you hold it for an additional 2 years, so at the 7-year mark, you're now getting an additional 5% step up in basis. So now you're paying tax only on that $850,000. The next crazy thing that is that works with these opportunity zones is if you invest that, say, $1 million, and then that $1 million of capital gains profit that you invested turns into $2 million. If you hold that asset in that opportunity zone for 10 years, that gain of $1 million on top of your original $1 million, that's tax-free. That's huge, right? Another thing that we stack with this is the bonus depreciation. So this is another change that was made in that Tax and Jobs Act, where you can come in and you can take up to 100% bonus depreciation on the facility and the materials to build it. And then you additionally get your standard deduction over the period of time, depending on what timelines you scale it through. So one of the things that we do to maximize this benefit is we do a cost segregation study. These cost segregation studies, an engineer comes in. We actually have one in CG that does it as well, Joe. Comes in, he breaks apart everything on this facility. He takes out the land cost, then he starts looking at, okay, you know, the roll-up doors, those will depreciate faster than, say, the steel I-beams that are in between each of the units. The corrugated steel, that's going to depreciate faster. The doors are going to depreciate faster, literally to the T, every little item in that facility. And then you can start increasing some of these depreciation schedules to 5, 7, 10 years, as opposed to taking I believe, what is it, the 29 or 37 and a half?
30 something, 37 and a half or 39 and a half or something.
So that, when you could take that much depreciation, all of a sudden your cash flow is it's going through the roof.
Man, this is huge. And I was only really talking about depreciation. I thought you might talk about cost seg or something, but man, you talked about the bonus depreciation, that Trump passed, and also the opportunity zone. So I'm guessing you're looking for big commercial buildings within opportunity zones to do the adaptive reuse model.
Yeah, and we're even looking for land in these areas, right? So there's a little bit of a caveat to these opportunity zones, which you have to improve the property. Now, there isn't a lot of really finite guidance on this. So we've been looking at case law, and our tax attorneys have been studying, and they say, hey, you should be fine if you add 100% to the basis. So what does that mean? It's great for ground up development and adaptive reuse, because as long as you add 100%, so say I buy the land for, here's an example. We just bought, we're doing a ground up development in Aurora, Illinois. We bought the land for $300,000, and we're going to build a $8.4 million facility on top of the land, right? So that's well over 100% increase in the basis, right? So that will qualify for one of these opportunity zone little caveats.
And it's in the opportunity zone, right?
Correct. Yeah, we bought about 4.5 acres in an opportunity zone.
That's awesome. That is huge. I love it. So, somebody that wants to go down this road with you, what do they do? I mean, what kind of opportunities do you offer for people who like, hey, I got some gains in the stock market, and I'm worried it's going to go back down. I want to play. I want to do this. I want to get the tax benefits. I want to defer it. I want the bonus depreciation. I like what I'm hearing. What do you offer to people who are, interested in doing it?
Yeah. So I always tell people just to reach out to me. I give away my cell phone on all the podcasts I get on. My cell phone 630-408-8090. Shoot me a text or give me a call. And the very first conversation we should have are, what are your goals? Maybe they might not align with the type of opportunities we have. Are you looking to get cash in and out quickly? Are you looking to reduce your taxable income? Are you looking for cash flow? Are you looking for wealth preservation? And that's the very first thing we should talk about. If we have something that works that way, I usually tell people, sit off on the sideline for a little bit and kind of pretend like you're in a deal with me. So, when I'm sending out deals, just follow along. How is it going? Once we get the raise done, how's the construction timeline going? Look at all the photos that we're posting. Look at the numbers. Look at, once we get, certificate of occupancy, maybe drive by the facility if you're in the local market, and talk to my investors that I have on my deals currently.
Right.
That's usually the best way to do it. So you can kind of learn the space without having any capital invested. And then once you feel comfortable, give me a call and we'll see what we can do.
That sounds good, man. That sounds awesome. Man, this has been just a wealth of information. I really appreciate everything you've been sharing. I want to reach out to you as well. Like, I've got a building, this building right here, I've got it for sale, and I got to do something with the money. I don't want to 1031 it, but I was thinking about maybe I'll put it into an opportunity fund. Opportunity zone fund or something like that. I don't know. I was going to sell or finance it, but I've got a lot of equity and got a lot of gain on it. So hey, I might do something else. So, man, I want to talk to you about some of that stuff too, because I really like what I'm hearing. Maybe I can find you one of those adaptive reuse buildings down here.
That'd be huge. Yeah, we always I haven't. Looking back, we probably haven't done any deals on our own. The way that we got so big so quickly was by partnering with people. I think partnering is one of the best things you can do, because you spread the liability over multiple parties. And then, I'm one of those people that subscribe to two heads are better than one. And usually the sum is greater than the parts. Usually when you have two or three people together, you have the mental productivity of 4 or 5 people working. Everybody comes from a different background. They have different experiences. So everything, all the deals that we've done, almost, the past 100 or so deals that we've done up to this point, has all been done through partnering.
That's awesome, man. I love it.
Yeah.
Well, I really appreciate you being on. It's been a lot of good information, very educational, and I've learned a lot. I got a page full of notes right here too. So thanks, man. I appreciate that. It's good stuff.
Yeah, absolutely. And if you or any of your listeners just want to get a little bit more in depth, I actually put together a presentation that I built for a few of my partners that were only multifamily investors. And they called me and said, Fernando, why don't you just put together a quick PowerPoint presentation stating why you moved into self-storage and why it's a better asset than multifamily. So I have something like that on the ready I can send to people. Kind of gives the background of where the self-storage industry was, where it is today, the advantages that it offers, tax advantages, also some other things that we didn't cover, like the sticky factor and reactive pricing models and ancillary profit centers. That's probably the easiest thing. There's a lot of really great resources online. Inside Self-Storage, their website has it's a national association. They have a bunch of great materials there. And then there's a Self-Storage Association, SSA. Their website also has plenty of information for anybody looking just to get familiarized with the asset itself.
That's really good, man. So if somebody wanted to get that PowerPoint from you, what would they do?
Yeah, just give me a call, or you can shoot me an email. My email is info@titanwealthgroup.com. titanwealthgroup.com. You can also go to our website, titanwealthgroup.com, and request the information, or just reach out to us. I know nowadays a lot of people like to use social media. You can reach out to us on any of the social media platforms, Facebook, Twitter, LinkedIn, Bigger Pockets. Just type in Titan Wealth Group or Fernando Angelucci, and you'll be able to find a way to contact us.
Awesome, man. Thank you so much. I really appreciate it. I want to get a copy of that too. So shoot me.
Yeah, I'll send it over.
That's awesome. That sounds good, man. Thank you so much. I really appreciate it. Everybody, this has been a great training podcast. There's so much content, so much information. Thank you guys so much for watching and listening. Please share. Please follow us. And please give us some feedback. Make some comments. We really appreciate that. And with that, thank you guys so much. We'll see you on the next show. Thanks a lot.
Thanks, Larry.
All right.
Bye.
Take care.